Hello everyone and welcome to another video. Today we're going to be looking at 5 indicators that are telling us that the market could be ready to sell off. And those are the Buffett Yardstick, the outperformance of utilities, market breadth, and also lumber versus gold. So let's get into it. Now let's start by looking at the Buffett indicator or Buffett Yardstick, also known as, and this is pretty much a simple measurement obviously developed by Warren Buffett, where you take the total market cap of the stock market and measure it against GDP or GMP, kind of depends how you want to do it. And basically this gives you an idea of where valuations stand, right? So as we can see, the blue line marks this Buffett indicator, right? Total market cap divided by GDP/GMP, right? So what is the size of the market compared to the size of the actual US economy? Now we can see that this indicator has been growing pretty steadily since 2009, right? This indicating that, stock valuations are going up, right? Now, this chart is right now also plotted against the TLT, right? The 20-year treasury rate. And I've done this for a very simple reason, and that is to illustrate the fact that, yes, we could arguably say that stocks have become overvalued over the last 15 years, but, we have to understand that this has happened in the context of rising, falling interest rates, right? So actually rising bond values, okay? So as we can see, the TLT, right, the 20-year treasury, has been climbing steadily since around that financial crisis. And of course, at the end of the day, a lower rate environment is going to be good for stock valuations, right? At the end of the day, you're using that interest rate to discount cash flows, and lower rates lead to higher implied valuations, right? Now, why is this important right now? Because we have seen a big disconnect, right? And we've reached a top here in bonds, right? We reached a top around 2021. And we've seen obviously rates begin to climb. In other words, bond values begin to descend. And that should, of course, have a negative impact on stocks. Now, we did see stock market descend towards 2021, 2022. But with that said, we've seen a divergence especially occur in the last few months, right? Where the stock market has continued to climb while actually rates have continued to fall, or rather, rates have continued to increase. So, first of all, this disconnect can't, in theory, continue for too long. And secondly, we have to consider also, in terms of more generally, not just looking out towards the next few weeks, but rather the next few months, what's going to happen to rates, right? And there's been a lot of talk about basically a secular bull market in bonds ending and now beginning a secular bear market. So, the higher for longer, could extend, eventually 10, 20 years. And of course, you have to think that in terms of stock valuations, we're going to be looking at perhaps much lower multiples and, the idea that, we could be facing a much longer bear market. But, more immediately, I'm at least focused on that disconnect for the time being. And now the next indicator that I want to look at is utilities, right? Now, utilities are, of course, a defensive sector. And one of the things about utilities is that they tend to outperform, as stock markets begin to decline, as we enter that part of the business cycle, right, as we enter recession. And we can see that, kind of arguably utilities have kind of acted as a kind of warning sign, right? We can see here, for example, that, utilities were making higher highs while the stock market, was already kind of starting to show weakness, right? Utilities here holding up quite well. We saw the same happen towards 2020, right? We saw utilities kind of start to take off, and also, towards the 2022 beginning of that bear market that we had more recently, right? So the idea being quite simple, that the market kind of takes in all this knowledge, and, when you start to see the utility start to outperform, that could be an early warning sign of the market beginning to weaken. This is something that is discussed oftentimes by Michael Guyett, and it definitely makes sense to look at this. And I do apologize if you're listening. It's raining quite a lot right now. So I don't know if you guys can pick up on that, but hopefully it won't affect the audio of the video too much. Oh, wow, it's actually starting to hail right now. Pretty crazy. All right, anyway, just to see this a little bit better, we can also see the relative performance of different sectors. And here we can see quite clearly that utilities on a 1-week basis have outperformed all other sectors. They've done pretty well on the month basis. And, well, on the day, you know, that kind of depends. This is looking back at Thursday, but they were still holding up pretty well on Thursday. And yeah, basically just that. Yeah, so the utilities side to perform, another kind of important indicator. Now, this is the lumber to gold ratio. Kind of also, the lumber is often looked at by a lot of economists, and this kind of adds another degree of depth to it, which is lumber to gold, right? Now, lumber, of course, is an important part of the housing construction market. So, you know, you would think that lumber is kind of a play on you know, kind of the business cycle starting to pick up again, right? So when lumber prices start to drop, first of all, that's an indication the economy could be slowing. And this is the lumber to gold ratio, right? And in the same way that utilities are kind of a defensive sector, you know, gold similarly is kind of a defensive asset. So when you start to see gold outperform lumber, once again, it could indicate a shift towards a kind of more of a risk-off environment. And finally, market breadth. And of course, you know, this was talked a lot back in May. And, you know, I actually made an argument back then that, you know, I wanted to see the smaller caps catch up. We did, in fact, see, you know, market breadth diminish, right? So what we see in this chart, just to be clear, is the percentage of stocks that are above their 50-day moving average. And we can see that towards the peak in August, that climbed to 75%. Over 75% of stocks were over their 50-day moving average. But, you know, since this last market correction, that number has fallen to about 30%. And, you know, even though the stock market in general, the indexes, you know, climbed back up near those highs, right? The S&P was at about 4,500 yesterday. I think obviously it's down a little bit today, Friday. We haven't seen the market breadth recover. And in fact, it's precisely at those levels seen back in May, just when everyone was screaming about market breadth. Well, you know, we can start talking about that again because market breadth is really not recovering. All right, guys, and that's what I wanted to say for today in this video. You know, just 4 important indicators that, you know, I think are worth looking into and could support the idea that, you know, we could be heading down. Now, this is obviously also backed by some of my technical analysis. And, you know, remember, if you'd like to check out my technical analysis and all of my other analysis, you can check me out on Substack. I have a weekly newsletter that comes out on Mondays. That's, you know, available to everyone. And there's also basically a lot of free content. And of course, you know, for anyone interested in more interesting stuff, there's also some paid content. So, but definitely go check it out. Subscribe to my Substack if you just want to stay up to date with all this kind of stuff. I guarantee you won't regret it.